So I'm just going to share a screen if I can.
Okay, we can see it.
Yeah, I just make sure it's on the. That's it. So just getting a load of rubbish out of the way. There we go. So 50 Years of Dependency Theory, named after Claudio Katz's book. I do recommend if you get the opportunity to read it, because Claudio does develop very clearly all the different strands of what is called dependency theory. But he does concentrate on what I would call the Marxist wing of dependency theory, and so am I. There are alternatives to that. The theory emerged in the 1960s and 70s as a critique of modernization, which, if you think that conventional economics, mainstream economics, argues basically that if poor countries could develop along the same path as the major economies in the world, if they followed the same approach of developing industry and opening up markets and so on, and that this would lead to the world becoming generally richer and the poor countries catching up with the rich. And the point about dependency theory is that they argue this is not possible because the poor countries are now systematically exploited by wealthy countries, and that therefore there's no possibility of the wealthy countries allowing the poor countries to catch up. This theory is mainly developed in Latin America, particularly when the so-called age of booming capitalist development after the Second World War started to come to an end. And in particular, that increased the crises for all those countries in Latin America and elsewhere in what we now call the global South, entered a period of crisis, particularly in the 1970s. So it seemed that economic development, as we'd seen in the West, was not going to apply to the global South. And for example, countries in Latin America like Argentina, Brazil, which had per capita incomes not so far behind some of the weakest capitalist economies in the north, in southern Europe, were not going to able to catch up, and that the hope that they would do so evaporated during the late 1960s and into the rest of the 20th century. So then those of us, not me particularly, but a lot of people started to look at the question of why that was the case. What was wrong with conventional development economics? Why could it not explain this process that was going on? We could identify dependency theories that have two main groups in the global economy, the core and what I call the periphery, a word that I think describes those countries that are outside what we might call the core of wealthy countries, the imperialist bloc, that Lenin would call it 100 years ago when he wrote his book Imperialism in 1915-16. Then there were just a handful of countries that controlled technology, finance, and resources. And 100 years later, we'd have to say that broadly the same countries that Lenin identified as being part of the imperialist bloc are still the same countries in the modern imperialist bloc that we can talk about in the 21st century. Nothing has really changed between the dominant imperialist group and the dependent rest of the world, the periphery. These countries, mainly in the north, almost totally in the north of the hemisphere, include obviously Great Britain and Europe, the USA, but also Japan, which joined perhaps the imperialist bloc by the early 1900s, and perhaps a layer of other smaller industrial or advanced economies in Europe and elsewhere. But we're really talking about the only ones we can think about in the southern hemisphere are probably Australia and New Zealand. So we have a very small group of countries that basically control trade, finance, and production through their multinational companies around the world, leaving the rest of the world, as it were, second-class citizens in terms of the economy. And the point's been made, I think, over the last 100 years is that nobody really has left the global south and joined the global north, and nobody has left the global north in this bloc. Very few, you can talk about maybe South Korea or Taiwan, but these are tiny countries which really did not suggest anything different. There are exceptions to the rule. And here's an example on my right. I show you a graph of how things have changed since if you like, the last 100 years or more, for two countries, Argentina and the United States, the per capita income growth, you can see that around about the time when Lenin was writing his book Imperialism in 1915, there wasn't much of a gap between the United States and Argentina in per capita income. But the dramatic rise of the United States per capita income and the general slow growth, if any at all, from about the 1970s in the case of Argentina, shows the huge gap that has arisen between the global North core and the periphery in the world, Argentina being just one example. Now, very recently, fellow Marxist economist Alan Freeman has been writing a paper in which he's looked at the growth and the divergence taking place between the living standards as measured by GDP per capita, in this case, between the North and the South of the world. He developed what you might call an index of monetary inequality. So basically, he looks at the ratio of GDP per capita in the North to that of the South. And this is his graph. And what does it tell you? If you look at the left-hand side, back in 1950, you can see that basically the per capita GDP of the countries, the economies of the North, was about 5 or 6 times greater than the per capita GDP of the South, which of course obviously includes South Africa. And you can see that throughout the period up until the 1980s, there was a gradual rise and divergence between GDP per capita in the North and that of the South. But in the period, what is often called the neoliberal period, when globalization takes place, when serious crises developed in the global South over debt and over trade in general, collapse of commodity prices and so on, we see a dramatic rise in that divergence to 20 times GDP in the North over that in the South. The ratio staying up throughout the period of the end of the 20th century and culminating in a 23 times level in the early part of this century, in the first decade. However, we do see that a significant drop after 2007-8, right down until the middle of the 2010s, very quickly. What was the reason for this? Well, Alan looks closely at that, and the basic reason is not that there was some dramatic improvement in the global South per capita GDP ratio compared to the North due to movement in the South, except for one country, basically China. We saw a dramatic change in per capita income in the first 2 decades of the 21st century. As China entered the world trade community, it developed a manufacturing and export base which just swept across the world in taking great shares of manufacturing and produced growth rates of double-digit compared to the per capita growth rates in the North of 2 or 3% maximum. So that, because China was such a big country, led to a sharp drop in the ratio between the GDP of the North per capita and that of the South. But since we can see in the last decade that we've just been through, leading up to the period where we are now, that gradually that divergence has again started to arise again. And currently, the GDP per capita in the North is on average 15 times greater than the GDP per capita of the South. And if we look back to where we are 70 years ago, basically we'd have to say that the possibility of convergence between the global South and the global North, between the periphery of the South and the core imperialist countries of the North, has not come about. There is no convergence. If anything, divergence has increased by something like 3 times since 1950, and there's no prospect that that is going to change. I had a quick graph for myself to look at per capita GDP for the BRICS. As we know, that's Brazil, China, India, South Africa. I've left out Russia for the moment, and compared that to the G7 economies. And you've got 4 different economies here identified. If we take Brazil, which is the dark blue line, we can see that Brazil was something like 10% of G7 GDP back in 1980. That didn't really change until the early part of the 21st century. Then we saw quite a large rise in Brazil's GDP. Have I got that the right one? Yeah. But that was mainly due to a sharp rise in commodity prices and commodity exports in the early part of the 21st century, which took their ratio up in GDP per capita terms, these are dollar terms, by the way, to 30%. But since then, in the last decade or more, that divergence between the G7 and Brazil's per capita GDP has fallen back. If we take the light blue line, that's South Africa, which I thought would be interesting to see, that South Africa was the closest back in 1980 to the per capita GDP of the G7, around 30%, only 30%, but nevertheless much higher than the other three countries mentioned here. But we can see over the period of the last, 40 years, that there has been no catching up whatsoever in South Africa. On the contrary, we've seen a decline in their ratio compared to G7 down to something under 15%, nearly 10%. The only country which has really shown a dramatic increase, as we've already mentioned, is China, which has moved from really basically nowhere in 1980, of just 3% per capita GDP compared to the G7, to now nearly 30%, and by far the most important development in terms of convergence, the only country which is showing convergence. But having even said that, China's per capita GDP in 2020 is still less than 30% of the G7 GDP. So there is a heap of a long way to go if China is to become part of the rich world over the next few decades. In fact, it's very unlikely that it will do so. Alan Freeman did some estimates looking ahead at current average real GDP per capita rates. 42 countries will never catch up with the global north. 90 countries at current rates would take longer than 50 years. So I won't be here to see if that was even possible for them to catch up with the global north. Only China and Vietnam stand to chance of catching up before 2050 at current average real GDP per capita rates. And apart from China and Vietnam, you'd have only 3 countries, according to Alan, Bangladesh, Indonesia, and Thailand, stand to catch up in less than 50 years. We're in 2025, if you like, 25 years. There's a chance that China and Vietnam might catch up in the next 25 years. And it's interesting perhaps to discuss why those 2 countries are able to have that possibility. But apart from that, nobody else is going to make it by 2050. And the vast majority of the global south, of the periphery countries in the world, the vast majority of countries in the world that are poor now will never catch up, basically, with the global north and the imperialist bloc. So that raises the general issue of why that is the case, and therefore raises the question of the theory of dependency, or the theory of the periphery, if you want another way of describing it, which I would, why they're not able to close the gap and develop in the image of the advanced countries in the north. And that brings us to the question of the nature of global exploitation and the dependency theory. Prebisch and Singer stated more than 70 years ago that although the South has been producing more and more, it's earning less and less for it. So the North has been producing less and less, its growth rate is less, but it's earning more and more. There is a transfer of value, of profit, of surplus value, in Marxist terms, from the global South to the global North. And that is the fundamental component, as Marx would argue, for the reason why there hasn't been a change and a move towards convergence between the poorer countries and the rich countries, as the basic conventional development economics would argue. And that what I hope to briefly describe is the nature of this movement of value from the South to the North through the process of unequal exchange in trade, and also through the movement of money and credit and finance enabled from the South to the North through multinationals and through the banks. One of the questions that will be discussed, I want to discuss briefly, is whether the differences of the switch from the South to the North is due to very low wages in the South, or is it driven by the technological superiority and productivity of the North over the South through its major companies and their technology? Do the imperialist countries, through their multinationals, gain surplus profits from the cheap labor of the peripheral countries, or from their superior technology and lower unit costs in international trade. Here is a table by Andrea Ricci, an Italian Marxist economist, who has analysed the input-output tables that are available on a world scale now, going back till about 1995. And you can look at the labour inputs and the labour outputs of different countries in various sectors and work out what the sort of transfer is taking place between different countries, particularly those from the south towards the north. And if you look at this table, we're taking up the period 1995 to 2019. If you take North America, where the US is, of course, you can see that annual per capita transfers at $761 in 1995 per capita is transferred into North America through unequal exchange or through trade in the world. That rises to nearly $2,700 per capita in 2019. So it's nearly increased by 4 times the amount that North America is gaining from the poorer countries and other countries in the world. As a percentage of per capita GDP for the US, that means that in the recent period, something like 4% of US or North American GDP is achieved from a transfer from the other countries of the world, the poorer countries of the world, through trade and other means into the hands of companies in North America. The Eurozone has a similar gain. Western Europe, you can see basically the first 5 blocks here have a positive gain from unequal exchange and trade. Oceania means Australia and New Zealand, basically. And East Asia basically means Japan here and perhaps Korea. But you can see there's a positive swing of resources and money and trade from the south to the north. Then if we look at the BRICS, we may be surprised to note that although China runs a huge trade surplus with the United States and with many other parts of the world and continues to do so through its manufacturing expansion and export, that doesn't mean that it gains the value out of that surplus. In fact, because it runs such a big trade surplus, there's a huge transfer of value, which I'll explain a little bit more about, from China to the global north. In fact, something like 10% of China's GDP, per capita GDP, is transferred from China through its trade to the northern bloc. And as you go down the list, you can see with South Africa, we can see Russia, Eastern Europe, South America, and so on. Basically, there is a negative transfer in all the areas of the global south over the last 25 years as a result of the process of unequal exchange in international trade. What does that mean? Well, we did a survey with my colleague Guglielmo Carcedi to look at this process of transfer from the periphery to the core economies through unequal exchange. And we found it was mainly due to productivity differences and technological superiority. In other words, the multinational companies of the north have technological superiority. They have low cost production relatively compared to what the companies in the poorer countries, the peripheral countries, produce, domestic companies. As a result, when there's a process of competition in international trade for various production of commodities, then they have the advantage. They can win their battle, they can drive international prices down and bring about a transfer of value from the global south companies and their industries to the north. It's mainly a question of technological superiority. We worked out that the relative contribution of having better technology, which is the word OCC, the Marxist term for organic composition of capital, versus having, as it were, a higher rates of exploitation in the global south through lower wages and higher profits as a result. That basically was technology, which was the main factor, not entirely. There is a transfer of value due to the fact that the rate of surplus value, the rate of exploitation in the global south in industries on average is higher than it is in the north, and not entirely, but the main factor is the level of technological superiority. But also, this is an important point, it's not due to lower wages per se in the global south, but due to the higher rate of exploitation if there's a transfer of value. So you could have a certain level of wages, but the level of profits that are being gained for that wages is much higher compared to wages. So it's the rate of exploitation which brings about extra value that can be transferred through international trade, not just the level of lower wages. This is a complicated table. I just wanted to explain this, if I can, briefly to you about what we mean by the transfer of surplus value through unequal exchange. So if we divide the world into two, the north and south, and we assume that for the moment, the rate of exploitation, that is the rate of profit over the rate of wages, is the same, around 100%. And if we assume that the capitalists of the north have better technology, so that the time taken to produce the value of the labor power that they're using, in other words, the workers, the amount of workers they require and the wages they can pay compared to the production time involved, is less than it is in the south, because they have better technology. So they use where the capitalists are using less technology in the south and more cheap labor, the capitalists in the north are using more technology and less labor. So in the north, we can say that there's 80 C, if you like, of technology, 20 V of labor, and we've assumed that there's 100% rate of surplus value. So you get a total output in the north of 120, which is a rate of profit of 20%. And the rate of exploitation, as we said, is 100%. In the south, it's a different ratio. It's only 40 C compared to the north's 80, 60 V. The amount of labor being used is much more. The rate of exploitation doesn't change, so you get 60 surplus, 160. So there's a lot more surplus being produced in the south, a lower rate of organic composition. The rate of profit in the south, if there was no trade at all, is 60%. But what happens on international trade is that these two different levels of value are equalized through the process of international trade to one international price for any commodity or a series of commodities. So if we total that up, we get 120 C reduced in the whole of the world, 80 V in terms of labor, and 100% rate of exploitation, 80 S. So the total is 280 in the total value in the world, 120 coming out of the north, 160 out of the south. But if we average the rate of profit, divide the surplus value by the total amount invested, we get a rate of 40%. And if we apply that then to the original amount invested by the north, whereas they only got 20% if they were not trading, by trading, they get a 40% rate of profit, so they get surplus value of 65. And in the case of the south, on a 40%, their rate of their amount of surplus value, which is 110, is now reduced to 45. So there's a transfer between, of 90 down to 45. So there's a transfer gain in the process of international exchange and trade of 45 to the north out of the process of trade, and the south loses the equivalent of 45. It still has a profit. Southern capitalists still have a profit of 45, but the northern capitalists now have a bigger profit through the process of international trade. That is the process of international exchange which takes place. Note that in this example, the wages of the workers of the north are unchanged. They're still 80 C. In this sense, the workers of the north are not gaining by the oppression of their capitalists, of the capitalists in the south and the workers of the south. Both the capitalists in the south and north are squeezing more value out of the workers of the south, but then the international trade, there's a transfer from the north to the south. Now, there is an argument presented amongst dependency theories, particularly by Ruy Marini, that this unequal exchange, this exploitation, which explains why the south is not closing the gap with the north, is mainly due to what is called super exploitation. In other words, it's not just a process of the transfer of surplus value from the south to the north through international trade, but mainly, or at least as well, caused by the fact that wages in the South are so low, they're even below the value of labor power. I've been presenting a little formula in the basis of Marxist value terms, but the argument is that wages are even lower than the average value of labor power in the southern countries. So this is the reason. Devastatingly low wages, sweatshop low wages, super exploitation is really the cause of the transfer. So I did a little thought example here. So let's assume the workers in the South are super exploited and forced to accept a lower wage. In the previous example, the total amount of value going to labor was 60V. Let's say it's reduced to 30V. So now the rate of surplus value rises in the South to 300% compared to 100% in the North. And the process of the global market produces an average rate of profit that is higher than before at 65, because now there's been a greater amount of surplus value in the South because of very, very low wages. So in the example we have, the North doesn't change. It's still at 120V in total. The South now sees a change in the rate of exploitation from 100% to 300%, because there's only 30V now going to labor, and the super exploitation has raised the rate of surplus value, and S is now risen to 90. So when we do the average as we did before, we get now a rate of profit of 65%. So the capitalists of the North now get an extra 45 from the super exploited workers of the South. But so do the capitalists of the South. They get an extra. Total surplus value in the North and the South has risen from 80 in the first case to 110, but the South is still getting, the Southern capitalists are now getting more because of the super exploitation, yet most of that extra surplus value, which was originally 90, gets transferred through international trade to the North. So we end up with a picture now where both the South and the North capitalists have gained more from the super exploitation of the workers in the South, but through the international transfer of value in trade, the North takes a big lion's share of that extra surplus value that's created. Again, the wages of the North in the workers are not changed. They are still getting the same figure, 20V. In this sense, the workers of the North are not oppressing those of the South, because that's often argued that this transfer leads to the workers of the South gaining from the low levels of wages and conditions for the workers of the workers of the North are gaining from the workers of the South's low wages. That's not true. It's the transfer of surplus value that's taking place. In other words, more profit is being made by both South and North capitalists from super exploitation, but it's the North that gets the lion's share of that super exploitation. Whether super exploitation is the main reason, in other words, exceptionally low wages for the transfer of value from the South to the North, and therefore the conditions of exploitation which make it impossible for the peripheral countries of the South to gain, is the main reason, is a matter of debate. In my view, from a Marxist point of view, exploitation takes place in both regions, or in both capitalist sectors, but through trade there's a transfer because of the technological superiority of the North from the South to the North. Super exploitation may add to that transfer, but even without super exploitation, there is an unequal exchange into the hands of the Northern capitalists from the Southern capitalists, but both North and South capitalists gain from their exploitation of the workers. The other aspect I want to deal with, which is controversial, is sub-imperialism. I think this is quite relevant to the position in South Africa, because there are, I think, arguments presented for it that many of the BRICS, for example, these larger peripheral countries, which have not bridged the gap to the North, but on the other hand, maybe they have a basis for exploiting smaller and weaker countries in their own regions. So we can talk about, as Marini does, a process of what you might call sub-imperialism. That yes, there's an imperialist bloc, but those outside the original imperialist bloc also operate in an imperialist way. They can extract resources and surplus value and profit from weaker countries. South Africa from, I don't know, Mozambique, or Namibia, and so on, to play a sub-imperialist role. Brazil was the example that Marini considered, as exploiting the rest of the region because it's the largest country and perhaps has the ability through its companies to also play a sort of semi-imperialist role. I think this argument of sub-imperialism has certain dangers. First of all, logically, if every country is a little bit stronger technologically or otherwise compared to its neighbors, does that mean it can exploit those countries in the same imperialist way that the imperialist bloc does? Because in that case, every country is a bit imperialist or a bit peripheral. It tends to reduce the term, reduce the idea of an imperialist core and the peripheral or dependent south meaningless, because if every country has a bit of imperialism, it's not very helpful to us to explain the process of divergence. And I don't think the evidence shows that it is the case that Brazil, Russia, India, China, or South Africa are really sub-imperialist countries exploiting poorer countries in their turn while being exploited by the major capitalist economies of the North. If we look at the graph on the right, this is a measure of the amount of money, of income, credit, net per person going into the economies of the world through the process of trade, through the process of transfer of profits, rent and interest, through the process of capital gains being made by multinational countries and transferring it back to their original domestic base. And you can see that on that, adding that up, this is an IMF figure of primary income credit per person. If we look at the graph from the left to right, we can see that Sweden has something like nearly $5,000 per person getting credit, income credit from trade, investment, and capital flows, profits, etc., from the rest of the world. Then we have UK per person, this is, so from the US and so on. But you can see, basically, the countries that Lenin talked about in 1915, and we could talk about now, the imperialist countries, the bloc, they are hugely gaining from the world's transfer of resources, income, and wealth out of their superiority and position in world markets and in finance. But all the countries that supposedly might be sub-imperialist or have some imperialist role really have nothing in terms of a transfer of funds from the rest of the world. I look for Brazil. There's Brazil, way down, hardly anything per person. There is South Africa, hardly anything per person. What it means is that the transfer of credit, profit, and income to the northern capitalist imperialist economies is so great that anything they gain from elsewhere is tiny, really, in relative to what they're losing to the global north. And that applies also to other countries like China, which often is regarded as an imperialist country, or Russia too, really very low indeed. So my conclusion from this is that sub-imperialism isn't really a very useful concept for us to use when we're considering the question of the relation between the global north and the global south, between the imperialist core and the periphery. It may help to confuse the issue and therefore not provide us with a theory of dependency which is very useful in explaining the divergence between the imperialist core of the north and the peripheral countries, the rest of the world, mainly based in the so-called global south. So that's my general perspective on the nature of dependency theory in 2024, a theory which has been around now for 60, 70 years. As I said, there are different strands of it. I've concentrated on the Marxist strand. I've concentrated on the process of unequal exchange in trade, which Marini in particular has mentioned as the key factor. There are other factors like the transfer of income and profit and wealth, and by the net transfer of the gains from foreign direct investment and so on, which I haven't really dealt with in detail, but we could do. All those coming together. And another factor that's been mentioned too is the ecological exploitation and transfer of resources, the wealth of a country in terms of its resources, the planet, forests, etc., which has also taken place between the South and North. I haven't dealt with all that. It's not really dealt with very much either in dependency theory over the last 50 years. But what we do have is a theory which suggests, and is quite coherent and logical, that the conventional development economics, that if everybody progresses in the same way that Japan did, the US did in the 19th and early 20th centuries, then eventually countries like Brazil, South Africa, and so on will catch up and join the rich countries of the North. That has proven to be a mirage as far as the evidence shows, and I think dependency theory helps to explain why that is the case and why we cannot really see any change unless we change the overall structure of the world economy from one based on a drive for profit and the accumulation of capital by large privately owned multinational companies and the financial sector. So I think that's it for me. If I can